I can see we are complete with the panel.
Right there. Sorry about that.
Hello, Rowan. And I see this is absolutely perfect timing, as it's here exactly the right time to start with the panel and with this fantastic session we are having here. So good morning, good afternoon, good evening, wherever you are. A warm welcome to this first session of the Disaster Resilient Infrastructure Dialogue Series on Finance for Resilient Infrastructure. We today will talk about disaster risk finance for public infrastructure assets in the developing world, looking at opportunities and challenges. But before I continue, I would like to hand over for introductory remarks to Mr. Sandeep Pandrik, the Director General of the Coalition for Disaster Resilient Infrastructure. Please, Mr. Pandrik.
Thank you so much, Dr. Astrid. Thank you for organizing this webinar. So let me start by saying good morning, good afternoon, and good evening to everyone who is participating in this webinar. On behalf of Coalition for Disaster Resilient Infrastructure, I welcome everybody in this meeting. In the beginning, I would like to introduce CDRI to those who are not aware about CDRI. So CDRI, or Coalition for Disaster Resilient Infrastructure, was launched by the Prime Minister of India in 2019 in the Climate Action Summit in New York. We will be completing about 2 years in September 2021. We have 31 members, out of which 24 are countries and 7 are organizations. And almost all parts of the world are covered as members. So we have countries from America, Europe, Africa, Asia, and Oceania. All kind of geographies, small island countries, landlocked countries, and other geographies are there. As the name suggests, the focus of CDRI is to promote and work on resilient infrastructure, and disaster risk finance is one of the key components of going into that direction. So resilient infrastructure cannot work without risk finance. And that's why this webinar today, which is first in the series of dialogue which CDRI will be organizing in collaboration with our partners like InterResilient, CCRI, and other partners. And the final, for this year, the final dialogue will happen in the COP26 in November, where we will organize a dialogue on risk finance. So with that, I would like to say that CDRI would like to work on 3 sectors as of now, that is power, telecom, and transport. And we have also included health infrastructure and urban to start work on. But overall, we are working on a overall synergetic approach where we take interdependencies of different kind of infrastructure systems on each other. So if we take health infrastructure, especially in view of the COVID-19, then it is dependent on power, on digital infrastructure, and also on transport. So the sectoral infrastructure sectors are very much dependent on each other. With that, I would like to put on the table 3 points which are important from my perspective. The first is the infrastructure finance. As per assessments, about $94 trillion are required for infrastructure finance till 2040. And with COVID-19, probably this, and with a gap of about $50 trillion, but this gap may change with COVID-19 and the resulting impact on economies. So I think that's one important factor which will affect the risk finance strategies. Second is that while there are already so many risk finance tools available and are being worked out, risk finance tools need to be as per the requirement of the countries. So that depends on many factors, including geographies, the hazard profiles, and demographic profile and other factors. So that is one thing, how to come out with a suitable risk transfer or risk management instrument for a country. And third is that with climate change and increasing frequency and severity of disasters, the risk finance will probably, requirement will probably increase, or the profile will probably change. So how do we account for climate change in the risk finance strategy? So with that, I will again thank InterResilient, all our partners, and all the participants who are there in this dialogue. And I will hand it over back to Dr. Astrid. Thank you so much.
Thank you very much, Mr. Poundry, for this fantastic introduction and also already framing this session with a very fantastic panel with distinguished speakers. And I would like to briefly go through the agenda for today's event. After my introductory remarks, we will start with a first part to get to know you, the audience, a little better, then go right into an impulse. We will be inspired by Nicola Ranger. Nicola Ranger is Deputy Director by the UK Centre for Greening Finance and Investment at Oxford University. She's also head of Climate and Environmental Risk Research, Oxford Sustainable Finance Program within the Swiss School of Enterprise and Environment at Oxford University. She's previously held various positions at World Bank and the UK Department for International Development on Disaster Risk Finance. So fantastic experience and very much power here to give us an inspiring impulse. We will continue after this impulse by Nicola with a panel discussion with our distinguished speakers. We start with, of course, with Samantha Cook, the Senior Financial Sector Specialist within the Crisis and Disaster Risk Finance team in the Finance Competitiveness and Innovations Global Practice at the World Bank. Samantha coordinates the Crisis and Disaster Risk Management Program in South Asia, the Caribbean, and manages the Trust Fund for supporting disaster risk finance solutions in middle-income countries, financed by the Swiss State Secretariat for Economic Affairs. We also have Rowan Douglas, head of the Climate and Resilience Hub at Willis Towers Watson. Rowan has a team of around 100 experts, and the hub aligns and mobilizes the company's mainstream risk, capital, and people businesses towards our clients, the clients' growing climate-related requirements. Previously, Rowan served on the board of Willis Re as CEO Global Analytics and founded the Willis Research Network Universities in 2000. And I'm also very pleased that we have Mr. Isaac Anthony. Isaac is the CEO of the CRIF, formerly the Caribbean Catastrophe Risk Insurance Facility. So this is the world's first multi-country risk pool providing parametric insurance to Caribbean and Central American countries. Isaac has over 25 years of senior management experience spanning the areas of public finance, financial sector supervision, economic planning, and disaster risk financing, having held key positions with the government of St. Lucia, including Permanent Secretary, Finance, Economic Affairs, and National Development. So we will have a fantastic experience here, and the panel will be followed by questions and answers with you, with the audience. And please use this opportunity to ask our experts and raise your burning questions. After my closing remarks, we'll have a final call with the audience. Well, next to CDRI, and Mr. Pondrick, you have mentioned you have 4 organizations that are co-curating this dialogue series. One is the Coalition for Climate Resilient Investment, so CCRI, and CCRI is a private sector-led flagship COP26 initiative launched in 2019 with now 93 members representing 16 trillion US dollars in assets. The ultimate goal of the CCRI is to mobilize capital towards resilience by developing practical solutions that address the misprice of physical climate risks in investment decision-making. And of course, we also have InterResilient Global Partnership. And this partnership, and we have partners here as well, is a multi-stakeholder platform with currently 106 members, ranging from vulnerable countries to industrialized countries to the private sector, international organizations, and include civil society and academia. Under our Vision 2025, we strive to financially protect 500 million poor and vulnerable people in developing countries from climate and disaster risk through pre-arranged risk finance and insurance solutions by 2025. So we really have an ambitious goal to scale up climate and disaster risk finance and insurance solutions here to support the adaptation to climate change. Through the work of the partnership, we promote a comprehensive approach towards risk management. One of Vision 2025's 19 targets is, for example, to support 80 vulnerable countries to have a comprehensive disaster risk finance strategy in place by 2020. We also have various programs under the partnership. We have Caribbean Risk Insurance Facility represented here, but we also have InterResilient Solutions Fund, or the KfW soon to be launched Urban Infrastructure Insurance Facility in Latin America. And all those programs can deliver support to countries to address financial protection for infrastructure. I would like to stop here and have a quick poll to get to know you a little better. And you will see the 3 questions appearing. Thank you. You will see the 3 questions appearing here at the screen. First of all, we would like to ask you, where are you joining us from? Second, where do you work? For which organization, sector? And thirdly, how familiar are you with the topics of resilient public infrastructure and disaster risk finance? So please share your information here within the poll. And we'll see a quick overview soon. So you click on the different circles and you can soon see the result. It's going to be shared with our back office here. Wonderful. we see that we have a big majority of colleagues from Asia Pacific, followed by European colleagues as well. A very few from the Caribbean, some North America, some from Africa. So that's good. We have a good spread, but I think we are curious to see where you come from. So the government, donors, represent NGOs as well, but a stronger representation by the private sector and international organizations as well. Some from academia. And we see there's a different result on how familiar you are with the topic. There are some that are quite familiar, a third of the audience, but also more than a third is not really. You want to learn about resilient public infrastructure, and hopefully we'll get a good response in the end, as we are having another poll in the end, whether this really was helping you. So, time is running. And before we go to the first part, the impulse speech, I want to raise your attention that you can use the chat to type in any questions that might come up. We will be supported by the back office to bring up your questions and can enter them into the discussion, into the Q&A later on with you, with the audience. Yeah, I think I would like to use just an introduction and guiding your mindset into this impulse and discussion that will follow. Imagine you're a mayor of a very big city in a typhoon-prone area and are planning to construct a public transport system with maybe a bus terminal close to riverside. You have little money and you're glad you attracted international project finance to support the construction. Why? And when should you think of climate and disaster risk finance and insurance? And maybe you'll get some responses already through Nicola's impulse speech. The floor is yours, Nicola, to give us your insights here and to kick us off.
Thank you so much, Astrid. Well, I really hope I can help in answering that question. Let's see how I do. So I've been given the task of giving an overview of disaster risk finance for public infrastructure assets in 10 minutes. So let's see how I do. And really what I'm going to do is try to raise some of the key issues that then we can put to the panelists to hear more of the details. Well, firstly, thank you so much for the invitation to join this event. I'm absolutely delighted to be here, and I'm delighted to be able to speak to this huge attendance as well. It's really great to see so many people interested in this topic. So let me start then by just re-emphasizing again why this is such an important area, and actually, globally, but particularly in emerging and developing economies. So, to put some numbers out there, disaster damages just to power and transport infrastructure alone is about 18 billion a year in these countries. So you can imagine in countries where fiscal resources can be under strain, particularly in this ongoing pandemic, these disaster costs can have a really big impact on the government balance sheet and on the economy more widely. But actually, what I'm going to talk about here is the impact that can have on the wider economy and wider growth and households and business. And that can actually be about 20 times higher than the impact or that direct impact. So a study by the World Bank a couple of years ago estimated that cost can be up to well over 600 billion a year in these countries. So this is a really big impact on growth. And so ensuring reliable and resilient critical infrastructure services is a really high priority for governments and is a really core part of countries' economic planning. I would say it's also a really important area for social development and poverty alleviation more broadly as well. So this isn't just about the economy, but also about people and jobs and welfare. I also want to just point out that obviously these risks are increasing. So this is a problem that's increasing and something that we need to address. Firstly, well, we've all seen in the last two weeks the devastating heat wave in the US. There was research actually by my colleagues at Oxford came out last week showing that heat wave is now significantly more likely with climate change. So all of these risks are increasing, and a lot of them are having really big impacts on our infrastructure system. So in the US, there was really big impacts on roads, on power supplies, on water, all of these areas. Now, because this isn't just about high-income countries, it's also about middle and low-income countries as well. So an example here from the Philippines last year, Typhoon Goni, that had a really big impact on infrastructure systems as well as the people and livelihoods as well. And then the final one, one of the key challenges here that I'm going to try to raise is that this isn't just about the assets, it's about how these assets work together as a system. And I think COVID in particular has demonstrated this interconnection between our economy, our infrastructure systems, our livelihoods. And that's a really important part when we're thinking about protecting infrastructure. We need to think about it from this systems perspective. And so I really have 3 points I really want you to take away from this. So one is, the incredible importance of this area, and I think is often undertreated in the dialogue about disaster risk finance. The second one is that I'll show you is that actually we have the tools to deal with this. So a lot of the systems are already in place. And then the third one is to think about this in terms of not just the assets, but also the services, so the power, the transport, etc., that those assets are providing. So why is risk financing important? And I saw in the poll that quite a few of you are new to disaster risk finance. So firstly, from a fiscal resilience point of view, so a sort of government balance sheet perspective, disasters and including the damage to assets owned by the government are one of the largest sources of contingent liability on the government. And that means when a disaster happens, it can have a really big impact on the balance sheet. And this has many knock-on effects in terms of ability to spend in other areas, debt, etc. So this is a really important issue. And risk financing is about providing financial protection against those risks. So it's about smoothing those risks and making sure that finance is available when it's needed. The second point is around, and I mentioned this sort of social and economic wider dimensions of this. So what we know is that when finance is delayed post-recovery, which can happen if we're not preparing well, so we're not thinking about risk finance, when there's that delay, it can really amplify the social and economic costs of disasters. So if, for example, reconstruction of critical infrastructure is delayed because the finance isn't available, that can really amplify the impacts on an economy and livelihoods as well. And so risk financing is about making sure finance is available at the right time and at the right place. And then finally, all of this sinks into longer term adaptation. So while it's predominantly about managing shocks, actually, insurance and risk finance more broadly is very critical in terms of making sure risk is encoded into decisions in infrastructure. If we don't have that, we won't be able to adapt in the long term. So this is really important for thinking longer term as well. Now, one of the key things that people think about when we think about public assets and financial protection of public assets is that the insurance of the asset itself. And I'm going to try to explain that actually we need to think more broadly than that. But just to say that this is a really tried and tested area. And I know some of the panelists will mention some of these examples, but there is sort of working insurance schemes in place across many countries that protect public assets. And there's a huge amount of knowledge out there that can be leveraged. I'll point to, for example, a great publication by the Insurance Development Forum, some great publications by the World Bank, and one I particularly want to highlight is the Public Assets Financial Protection Program, the World Bank's training program, which is all open and available. So if you're interested, you can really dive into that and see those resources. But I want to talk about this services, because if you're interested in economic growth, if you're interested in livelihoods, yes, the asset is important, but the thing that's really important is the services that asset is providing. So the energy, the healthcare in the case of hospitals, transport networks, education services for schools, water. So yes, it's about protecting the asset, but we also need to think about how can we make sure that when a disaster happens, that these core services are not disrupted. And it's getting those core services up and running post-disaster very quickly. That's what's really important in terms of reducing the economic cost and the social cost of disasters. And this is something that we looked at in partnership with the World Bank and had a report out in March, which looked at what's the difference if we're trying to move from just thinking about our traditional focus on assets to financial protection of services. What are the key differences? And to summarize some of the conclusions, so one is that if you're thinking about services, it's part of it is that there are risk financing instruments out there that can help, but you have to think about how it's about planning more broadly. And there's lots of examples in place of where governments all over the world have put in place financial protection mechanisms that support continuity of services, and there's some examples given. What's really important as well is this government macro lens. So often when we think about financial protection for governments, we miss out this implicit, what we call contingent liability. So this is what the government is responsible for that's related to services. So after a disaster, often a government will have to step in to pay to get services up and running. And often we're not taking that into account when we're thinking about managing risk to governments. And the final point that we found that was really different was when you talk about the services and not just the asset, there's a much more complex array of actors that you need to bring in, and particularly the private sector. So public-private partnerships are really important, as well as things like regulation as well. So in summary, a key lesson from this was that when you're thinking about disaster risk financing for infrastructure and public infrastructure, there are three bits that you need to think about. You need to think about that macro scale and make sure you're capturing the contingent liabilities associated with infrastructure. So everything that cost that the government is responsible for after a disaster, and make sure that they have the right plans and instruments in place to manage those risks. The next one is actually the protection of assets itself. So this is making sure that the public assets, be it bridges, roads, schools, government buildings, have the right protection in place. And then the final one is thinking about how do we get services up and running quickly after a disaster, and what's the role of finance in doing that. And then on that final one, again, it's part of it is about the financing, but it's also about linking that into other types of emergency planning and contingency planning. So it's really, in this area, you really need to join up the disaster risk finance and the people thinking about how do you get a rapid recovery post-disaster and link those two things together. So in terms of some of the issues and challenges then in this space, and so this is something I was particularly asked to look at. So in terms of financial instruments, for infrastructure, there are many different instruments out there, different ones relevant to different types of infrastructure, but often there's a solution to a particular problem, and we'll hear about some of those from the panel. One of the challenges, particularly in emerging and developing economies, is the domestic market capacity to take this risk. So often, particularly in the lower income countries, the insurance market is either too small, or the enabling environment there in terms of having the right regulations in place. There's some work that needs to be done there in order to provide insurance for public assets. The second challenge is around sort of data and analytics. So the data needs for protection of individual infrastructure are more significant than, say, if you're thinking about national disaster risk financing. So there's an additional need for data. And if you're thinking about the systems perspective, a need to understand risk to systems, and I'll come on to that very briefly. But then the final one, I think, is around the capacity and institutional readiness to implement these types of initiatives. As I say, it's one thing to have a great financial instrument in place, but if there's not the right systems, capabilities available on the ground to make sure that finance gets to where it needs to, and in terms of rebuilding assets or getting systems up and running again, then the impact of that is significantly reduced. So having that capacity and institutional readiness in place is really important. Now, I've put these as challenges, but I think all of these are resolvable, and certainly through partnerships like we've got here, the CDRI, CCRI, organizations like the World Bank, the InterResilient Global Partnership, the IDF, there's so much focus now on making progress in this area. I'd like to point to a really important role for Riskpools I see in this as well. And I know we're going to hear about CRIF from Isaac and the great work they're doing. I'd also like to point out CDRI, which is an ASEAN and World Bank initiative that's doing really great work on public assets, and hopefully we'll hear a little bit about that. So if I come back to my sort of strength in this just finally, which is really on the data and analytics side. So, I've posed this as a challenge, but I want to say this is a real opportunity as well in terms of the data that's becoming available. So my organization, which is the Center for Greening Finance Investment, our job is to look at how do we take the best available science and bring that into these types of problems. And one of our flagship initiatives is the Spatial Finance Initiative, which is all about taking new satellite data and bringing it into action. And then a final one that I would mention, which is actually a partnership between Oxford and the World Bank, is this systems analytics that I mentioned. And this is really important because to understand how to build resilience of infrastructure systems, so how to reduce the impact of disasters on real people, firms, etc. You need to understand how to protect the whole system. And with the World Bank, we've been developing a tool that will help to do this. And we also have a partnership with CCRI as well in Jamaica and some similar work. So just to summarize then, so firstly, this risk finance of public infrastructure, I hope I've convinced you, is a really important part of wider resilience and a really urgent need. There are challenges in this space. It's never easy, but there are certainly tried and tested approaches available. I definitely encourage you not just to think about the assets, but also to think about the services they provide, because from an economic and a poverty perspective, it's those services that are really important. And then finally, this is an area where really significant progress can be made. And again, I point to the importance of risk pools, particularly in middle and lower income countries, the opportunities through data and analytics and the innovations that we see in financial products. And I look forward to the panelists telling us more about that. And then finally, just making these links to wider resilience is really important. So I'm so pleased that there are so many people here from the infrastructure community, because creating more dialogue between the infrastructure community and the finance community is really what's key to making progress in this area. And I'll finish there. Thank you very much.
Thank you very much, Nicola. That was a fantastic opening and very thoughtful contribution and impulse for the discussion. I would like to kickstart a discussion immediately because you raised the challenges so nicely, and we'll certainly look into that through the question. So I would like to pose my first question to you, Samantha. So there are certainly examples out. So probably you can tell us some examples why it is critical to protect public infrastructure assets against disasters to ensure macro fiscal stability, as Nicola has very much emphasized. And how important is it to use pre-arranged tools for financing infrastructure losses? And the losses are getting bigger and bigger, as we have seen. So, Samantha.
Thank you, Astrid, and thank you, Nicola, for the nice overview. Very much a pleasure to be with everyone here today. So I wanted to make just a couple of points to reinforce some things that Nicola said. First and foremost, I really wanted to make the point that resilient infrastructure, it's actually about people. We very often get detracted focusing purely on the assets. But the reality is your larger losses or your implicit contingent liabilities, those where the government ultimately has a social responsibility to respond, they're about 4 times the size of your direct damage. And so I just wanted to make sure that people really kind of understood that. So when we talk about, for example, if we think of a bridge, it's very easy to think about the direct damage to a bridge and how we finance the repair of that asset. What we don't think about is what the bridge is actually used for. So people could be using this bridge to get to the hospital, to get to school, to get to their place of work. Being unable to get to your place of education, your place of work, to the hospital, that's going to have your economic impacts. That's where the government's going to start to see a decline in their revenues from business interruption. There will be longer term impacts dependent as to how long children are unable to go to school. So it can be intergenerational on the economic impact. I wanted to make that point as well. But what the government is also faced with in terms of these declines in revenue, it's also facing higher expenditures at the same time. So they're going to have to think of ways in which they can support their constituents in the meantime, as well as being able to repair that asset. So they get hit ultimately on both sides of the balance sheet in that aspect. So in terms of what can be done, and really I hope this is starting to make sense and to resonate, that there is a need for pre-planned finance. My favorite example, I have to say, is not actually an insurance-based example. It's actually from Japan. And what happened in Japan was there was a large earthquake, but because the government had in place pre-arranged contracts for the repair of their infrastructure, they were able to rebuild the East Nippon Highway within 6 days. And I think that is a fantastic example of governments thinking in advance, incorporating it into their planning procedures as to how they can reduce that gap of what I'm going to refer to as economic inactivity in that sense. Now, what we do on our side at the World Bank, there's a few, this is still an emerging area for us ultimately. There's a few areas where we're combining infrastructure with disaster risk finance, and we've got some pilot projects being financed by the Global Risk Financing Facility. To give you a few examples, so in Indonesia, we've been working with the government of Indonesia with CDRI, basically to explore insuring their public assets. So they currently have 28 ministries that have formed ultimately their own pool to insure their assets. The aspiration for this is ultimately to look at key buildings in the first place, so key government ministries. There is the horrendous example from Haiti, whereby the government became fully dysfunctional because the Ministry of Finance collapsed and unfortunately had the staff within it. Horrific event that we hope is never repeated. So Indonesia, they've taken the stance to insure those ensure their buildings first and foremost, but the aspiration is to expand this to other key public assets. And at the moment, they're covering about half of their ministries, so just over half, it's 28 out of 55. But coupled with that, CDRI is actually providing a lot of technical assistance on the advisory and analytics side to make sure that they fully understand that yes, insurance is wonderful. It will certainly help with the protection of the physical assets. But ultimately, you need to think about this a little bit more and ensure that you've also got sufficient budget towards your operations and your maintenance of your assets. If your asset is not in good condition, you're going to struggle to really secure insurance for that asset in the first place. And if it's damaged before a disaster happens, the disaster is going to have a much larger impact. Your assets become more vulnerable. So really, they're thinking about it from that perspective. There have been some discussions, but not pursued, as to what can be done on the business interruption side. I'll be honest, we're not quite there yet, but something we're definitely considering. Burundi, similar idea, also being supported by GRIF. They actually have a national road fund. And this National Road Fund finances the repair and rehabilitation of the road network. What we want to do is introduce a shock responsive component to this, which in the first instance, it will be financed through a fuel levy posed by the government. So we're looking to have a discrete pocket within the existing fund to help provide that rapid injection of finance to be able to conduct those repairs. So very much of the aspiration, like the East Nippon Highway. And again, there's a need to have discussions about the value of pre-arranged contracts and being able to enforce said pre-arranged contracts. We also have other examples from Bangladesh and Nepal, where we're starting to look at water infrastructure, the hydrometeorological investments. They're incredibly expensive, incredibly important assets. So we're exploring how we can look at that as well. So these are just some of the options, along with insurance, as to how you could finance and make sure that you've got that pre-arranged finance, because let's face it, in the current environment, with COVID, we're currently in a period of economic recovery. Governments, including donors, have less money than normal, and you really need to go, or you're really going to have to work to think about how to work with the private sector and what risk you can potentially transfer onto the international markets as part of it, because you really need to secure that private capital to complement your limited fiscal budget. And I will leave it at that. Thanks.
Thank you so much, Samantha. And you made a perfect segue to my next speaker here, Rowan, private sector. So having heard implementing organizations, what role does the private sector play here in implementing market-based means, supporting the government, supporting also with regard to risk financing and transfer for infrastructure assets? And we've seen there has been a study from the Insurance Development Forum on particularly that. So how can private sector contribute best, and what are the experiences regarding uptake of such risk transfer instruments for public infrastructure?
Thanks so much, Astrid, and thank you to Nicola as well for setting the scene so comprehensively. There was an awful lot in Nicola's presentation, which I want to try and hook onto, and also to Samantha for the great examples. And I will sort of expand on where the private sector can play, but there's probably also some more general observations I'd like to make as well. So clearly, the private sector, and over the last 10 years or so, we've seen a growing integration of the private insurance industry, if I can describe it like that, including its related capabilities like risk modeling and even investment, become steadily more integrated into public finance through relationships with governments or through international institutions. And certainly that journey has been steady, but it's now growing fast. And clearly there are a range of capabilities that the industry will bring, particularly around modeling and sort of economic management, which is helpful. And you've identified the Coalition for Climate Resilient Infrastructure, investment, which is a partner of CDRI, which is seeking to understand how we integrate physical climate risk into the very DNA of infrastructure investment, so that obviously assets can be built and developed with risk in mind. So we're growing resilience, not risk, but also to ensure that we make it economically rational to invest in resilience, because until risk is accounted for, it can't truly be valued. So, and as Nicola highlighted, there's a tremendous amount of detailed guidance out there for people who are interested in this topic. And Nicola showed on her screen one, which is a great document produced by Claudia Time, colleague of ours at the IDF who works for AXA. It's a great sort of guide. So I'm sure some of that will be circulated by the CDRI team afterwards. But I think I just want to highlight one particular really important essence, and hopefully it lines up for Isaac coming up next. It's really important to see insurance not as a product. Insurance isn't a product. Insurance is actually a system of governance. And insurance isn't an industry. Insurance is always a mechanism that's one way or other a public-private collaboration. Insurance is regulated, particularly in this space. And ultimately, I want to bring up a theme that Nicola mentioned around risk pools. This is the link to Isaac. We think of when we buy insurance, whether we buy it for ourselves as a consumer or even a government may be buying insurance, that you're transferring the risk to somewhere else. You're paying some money and you're saying, I can forget about it. And some people even think it's a disincentive for resilience. Actually, you're not really transferring it. That's a misnomer. What you're actually doing is saying, I am going to share my risk with others in a community, in a risk pool. It could be an insurance system, public or private. We all actually share risk as citizens through our taxes. But basically in insurance pools, you're saying, I'm going to share my risk with others and they're going to help me when I have a problem. But equally, my money isn't actually being saved for me. It's actually going to contribute to others when they have risks. But in order to make these pools sustainable, if you're going to join a pool and make it affordable, people have all got to manage their risk in a reasonable way. That's why we have rules when we take out insurance contracts. For our home, we have to do certain things. And we forget what an incredible cultural achievement risk pools and insurance broadly defined. I'm not saying just purely insurance in terms of the industry. We have all sorts of forms of insurance where we commit money now to obey some rules and we will receive funding if a crisis happens to us. And I just want to highlight that risk pools are a really special, forgotten asset that is going to become so much more important in our more risky climate world. And we have to think about this institution in a new way. And my final point before handing over to Isaac, and hopefully I've set you up, Isaac, for the role of CRIF and others. But many people will be saying, but why do we have to do this? Because as Nicola said, this is all about people. It's about livelihoods. It's about services. It's about our way of life. And what could be more important than that? But regretfully, and I mean really regretfully, for some reason, that hasn't been enough. Because regretfully, whether it's here in the UK where I'm speaking from or elsewhere, we seem to be prepared to accept all these losses to schools, to hospitals, to our energy system for risks which are actually foreseeable. Some are even forecastable. And for some reason, we don't seem equipped to confront the realities of what that means in terms of human suffering enough. We should, but we don't. We need help. And help is on the way. Help is on the way through the strange world of accounting. And this is where it'll become important. So partly, yes, I know this is beyond climate. The CDRI has a broader mandate. But there's obviously a set of drivers around climate resilience policy that is beginning to become much more significant in terms of countries' public policy. But there's actually a more invisible force. And it's the invisible force that the world's financial system, both private as well as public, is under a process which many on the call are involved with to make climate risks, including physical climate risks, accountable. So it's a bit like having a medical. I'm 52. I've got due for my medical. I'm not looking forward to it. It's going to give me bad news. And, you know, what it's going to say is you've got to spend a bit more time in the gym and eat better stuff because you could have an extreme event in the next 2 or 3 years if you don't. And what we're talking about in this whole approach is we're all going to have a medical in our terms of our climate resilience. And if we're not fit, we're going to have to pay a lot more for our investment, for our capital. The World Bank will start setting new rules, investors will start setting new rules, and it's that is going to hit us all over the next 5 years, both to manage our existing infrastructure, but also our future infrastructure. So all these forces are coming together. And as Nicholas said, we have all the capabilities, and through initiatives like CDRI, which proves how important governments are taking this issue, we can crack this problem together along with the other 206 folks on this call. Over to you, Astrid. Back to the studio.
Thank you so much, Rowan. I love what you said, looking at insurance as this concept of a solidarity pool, because that really brings us to the original idea behind insurance. And pool is the segue to you, Isaac, because it is lovely to see that the solidarity pool is carried to the next level, maybe through the sovereign risk pool. So based on your experience, Isaac, running the CDRI, what role do you think sovereign risk pools play, especially now in the future, in providing the cost-effective financial solutions for developing countries, particularly in protecting public infrastructure? How is your experience with the relevance of the infrastructure protection? I mean, with regard to even different types of infrastructure. So please, the floor is yours.
Yeah, thank you very much, Astrid. Thanks for your warm welcome. And let me also take this opportunity to thank the organizers, CDRI, for inviting me to be on this panel, on this very, very interesting and a very timely one as well. I think the previous speakers have already provided, I think, a very good context of what we are discussing today. But I think the honor is mine to just speak a little bit about, you know, a risk pool and certainly the role that they can play in terms of providing cost-effective solutions. Sovereign risk pools, I mean, such as CRIF, which is supporting the Caribbean and Central America, and African risk capacity, that's ARC and PICRIC in South Pacific, I think are really well placed to do so. You know, CRIF was established to provide parametric insurance to governments of the Caribbean, and as I said, now Central America. And the whole idea is to be able to provide quick liquidity in the immediate aftermath of a disaster. So it is interesting that when we started operating, the focus was really on providing some form of business interruption insurance, so that the countries can be able to get that quick liquidity to be able to support the recovery. So we really see it as a key element of disaster risk financing. And increasingly, the insurance that we provide is being recognized as a mechanism for building a resilience, particularly now we see the significant impact of climate change. Now, perhaps I should take this opportunity, and it's a point I think that the other speakers have made, that it is really, insurance is really not an end in itself, but it is really a means to an end. And that end is really about managing risk that people face on a day-to-day basis. It's about people, it's about being able to recover quickly from natural disasters, etc. And governments do have the ability, when they receive, for example, the payouts from whether it be CRIF and other risk pools, to be able to deploy those resources for different purposes, whether it be immediate post-disaster activity, for example, like cleaning up, maybe providing food, medicine, and so on. But what we're also seeing is that, you know, and although that was not necessarily the original intent, but we're increasingly seeing government using some of those payouts to rebuild infrastructure and so on, such as whether you talk about roads, bridges, schools, hospital plants, etc. So risk pools, and I guess the question is, you know, ultimately, what exactly are they, and why are the risk pools able to offer cost-effective solutions? Well, first and foremost, it basically, the risk pool is able to pool risk into a single diversified entity. And what is possible from this is that because of the risk diversification, and you're basically pooling the risk, and I think Rowan explained it very well about being able to share that risk, it means that the unit cost of that risk actually reduces, and therefore it means that the individual participants, whether it be the governments and so on, is able to benefit from that reduced cost. So that is one. There's also the other benefit that comes with economies of scale. So as you have more governments, you're able to spread that cost to many more governments, and therefore you reduce that cost, and that benefit is then passed on to the individual members. The other point that I want to underscore is that CRIF, for example, really operates akin to a not-for-profit insurance company, with all the residual benefits or surpluses, if you may, being plowed back into CRIF for the benefit of members. So we do not operate to make profits to pay shareholders and so on. Everything goes back, is plowed right back into CRIF in order to actually benefit the members. So what that does is that it does give you the opportunity to reduce costs even more. We are able to retain some of our capital, and by retaining capital, it means then that we sometimes able to, not sometimes, that we reduce the amount of risk that we transfer to the international reinsurance and capital market, thereby enabling us to be able to offer our products more cost effectively. But even when we transfer risk, because it is inevitable that we have to transfer some of the risk, because, and I think that is one of the main partnerships that has really led to the success of the CRIF. And you know, we've been able to establish a really excellent relationship with the reinsurance markets over the years. And what I find interesting is that the reinsurance markets are increasingly recognizing the special role that risk pools have as what I refer to as disaster insurance, or if you want, development insurance companies. And that they are not in the business, as I said, to maximize profits for the benefits of shareholders, but they're really doing that to help vulnerable countries and so on, who really do need that level of protection. And certainly that has helped us in our negotiations. The other important point is that, and again, there was a study that was done some years ago by the World Bank that actually showed that the cost of procuring insurance through a risk pool is about 50% of the cost of what a government would otherwise have had to pay had it, you know, gone to the markets directly. And so all of this really represents a significant benefit that is then passed on. So increasingly, risk pools are looking to provide asset specific. So while we started off by providing sort of business interruption insurance, increasingly we are seeing the benefit of providing, as I said, asset-specific insurance, whether it be for hospital infrastructure, schools, road infrastructure, and so on. And in fact, more recently, last year, CRIF was able to launch a new product for the electric transmission and distribution assets of electricity or power companies. As you probably know, some of those companies are actually owned by governments, but while others are actually owned by the private sector. But even then, when those assets are actually owned by the private sector, guess what? The risk is ultimately shared with the government, because when there's a major disaster in the country, you want your transmission and distribution to be running up and running as quickly as possible after an event. And so very often the governments are called upon to provide the required resources in order to do this. So we're seeing a huge opportunity for risk pools to certainly get even more involved in providing cost-effective solutions, you know, for public infrastructure. I will stop at this point.
Thank you, Isaac. This is a fantastic line of thoughts. I didn't want to interrupt you, although we are running with our time very fast. And I want to ask Nicola to keep some of the thoughts you might enter now here at that part for the end, for taking some action, because I think we can really distill here from this fantastic contribution. We also see a lot of questions coming in. Some of the questions might be answered right now already through the contributions, but some I would like to pick up in the end at the last minute. So let us look at some burning points, and I would like to look and quickly have a second round and then open for the discussion with the audience. So my next question would be to you, Rowan, because I think there is a good input by private sector coming up now. Nicola has mentioned the urgency of data and analytics. And we know this is a big challenge. So what can the private sector do? What are you doing here already to support the lack of the data and to close the data challenge? Rowan.
There we go. Thanks, Astrid. I'll try and be really quick, but also answer that question and some of the questions coming on the Q&A. The question I would sort of say is, there is a revolution happening, as Nicola indicated, in how the private sector and public sector together are working on the data and analytics to help people understand climate risk. I would say, I'm being very generalized here, the challenges of understanding the hazard, what the weather and the earthquakes, all the rest of it are doing, is some degree the easier bit. The really more challenging piece is actually how we understand the impacts on particular structures, on what is a government's own asset base, where is it, what's it made of, what are its vulnerabilities. But those are some of the really challenging data aspects, what we call the exposure and vulnerability functions. And then once you understand that information, how can it be consumed and integrated within your systems of government or in an organization? I think that's where private sector has a big role to play. And I just want to pick up, if I may, on a couple of the questions, because great questions coming through around the world of climate finance and disaster finance almost seem like different worlds. Or how can we sort of get training in this space? And that's absolutely, I think, where CDRI and the other initiatives come to bear. There is a tremendous amount of material now on the internet, as has been touched on, but I think there is a real opportunity to build on some great work being done by groups like the Global Association of Risk Professionals and the Chartered Finance Association Institute, rather, to actually bring these worlds together more. And I think it's this kind of initiative that will do that. But back to you, Astrid.
Thank you, Rowan. I would like to continue, and also Samantha, if you keep your answer short, where do you see the key bottlenecks in designing and implementing disaster risk finance solutions for public infrastructure assets from the demand and supply side of the system? So what role does, for example, World Bank or other multilateral development banks have and could play? And you mentioned some of the examples, but probably a short and quick answer here.
No problem. Thanks, Astrid. On the demand side, I would say there's two areas ultimately. From particularly a government perspective, it's often viewed as expensive. Very pleased to hear Isaac's example of the energy sector now being incorporated. State-owned enterprises have always struggled in order to be able to strike that right balance. Expense is also important because you need to remember, from a government perspective, your insurance premium is competing with other aspects of the budget, like operations and maintenance. And it's something that can serve to be a deterrent. Similarly, often governments are unaware. If people aren't thinking about risk as part of their planning process and their budgeting process, they're not really looking at what could happen down the line. So ultimately for these governments, these shocks are going to be somewhat larger because they just haven't thought about them. It wasn't there. They don't know how many assets they have. They don't know what their exposure is, what the vulnerability of these assets is. So for example, to give a prime example of this, in Fiji, the main government mainframe, their main IT system was actually located right on the seafront. Not perhaps the most sensible place to be locating it. And so they had to invest in a huge project to start moving it away to a safer area. On the supply side, what I would really emphasize here is just data. Often basic data is missing on the exposure side of things. So without your basic exposure data, without knowing the location of your assets, the condition of your assets, this is incredibly problematic when trying to develop some sort of response and understanding how much finance would be required. That's the point that I would really make on the supply side. As we know, there are solutions that exist, but really the data constraints, particularly within developing countries, is the biggest aspect. What role can MDBs play? Ultimately, ours is largely advisory and analytical capacity. So what we can do as part of the way in which we interact with countries is make sure that countries are aware, first and foremost. We can also help provide some element of finance towards managing this risk. And develop integrated approaches. For example, in Nepal, I mentioned they're looking at building a large dam in the upper Arun Valley, basically looking at that right at the beginning of the project, making sure that they have some form of financial protection in place while the asset is being constructed, but also once it's being constructed, consider the value of the asset over its lifespan. And that's quite a unique role that the MDBs get to play. We're also able to act as basically some form of, I've heard terms thrown around like development broker, development insurer. I'm not really a fan of those terms because we should be impartial in that regard, but we can certainly offer an impartial opinion on the structure of financial products, the analytics that underpin them, but also, and perhaps most importantly, this is my last point, it's recognizing that if you only focus on the finance aspect, you're not going to be addressing the whole problem. And I will leave it there. Thanks, Astrid.
Thank you, Samantha. I combine a question from the audience already with my last question to Isaac, to you, Isaac. The question is, public assets are oftentimes not adequately registered. This is actually a prerequisite for disaster risk finance. And I remember also you had reflections when we discussed this panel, this session, on different sectors, like, I mean, looking into electricity grids and so on. Could you please elaborate more on this challenge and what kind of support can be offered? What kind of solutions could be provided by the risk pools here?
Yeah, again, yeah, that's an excellent question. In fact, it really is one of the big challenges I think that we have, certainly in the public sector. I mean, the government is the repository of significant amounts of assets. I mean, yeah. And but if you really do a proper analysis, you will find that much of the assets are not properly registered. You don't have proper inventory systems and so on. And the information that is so important to support effective analytics and insurance, and to enable the countries to effectively manage the risk associated, with those assets are clearly not available. So clearly, and I think all the speakers, including Nicola, have addressed the question of data analytics. In fact, as we move more into the space of providing insurance, what I call asset-specific insurance, we are recognizing that is actually one of the big issues. I mean, I spoke a while ago about the product that we launched for transmission and distribution to support the power sector and so on. But one of the things that's really, impeding the progress here is just the availability, of the required data to be able to complete modeling work and so on. And I can say that for many other areas in the government. So I totally agree. I mean, registration and putting all information together is going to be key. I think there's no question that there is a role for you in assisting, those governments in putting that. And I think that would putting the information together and start collecting the information and making sure that we identify clearly, the level of the exposure, the characteristics, and so on, the age of the assets, and so on. So there's quite a lot of work to be done. And I think, my point is we have to start somewhere. Sometimes we sit back and we said, it's going to be too difficult to get this done, but you have to start somewhere. And I think the role of the other agencies, whether it be the multilateral financial institutions, agencies such as InterResilient and so on, can actually play a very big part in helping the governments, get these very important initiatives off the ground.
Thank you, Isaac. And I pick on another question because I think this is a very appropriate for Samantha. Before I go to you, Nicola, with a third question and combining the third question then and the answer with a wrap up of some action points. But Samantha, first, there's a question on how can governments facilitate the development and uptake of market-based instruments of infrastructure financing, whether it's for pre-disaster mitigation stages or post-disaster reconstruction stage. Do you have some thoughts?
Sure. So on that, I think there's multiple things that governments can be doing. Part of it goes back to what I was saying is incorporating risk as part of your budgetary process. So really thinking in advance about the risk that you're holding on your books, because that should be used to inform your operations and maintenance budget. So if you've got something like a public asset registry, ideally an insurance ledger, which will tell you when your policies will lapse and things like this, they're incredibly important for being able to do that financial planning. In terms of what they can do to develop the market, I think this is where it becomes more challenging, not insurmountable, but definitely more challenging. Because this is where I think governments really need to consider these public-private partnerships that Nicola mentioned at the very beginning. So is there some amount of risk that they would be willing to hold on their books? That is, are they willing to fund, for example, the first loss in order to help the domestic sector? And also, I think as well, there's an element of awareness. A lot of the time we see it can be prohibited by some governments. I'm not going to mention which ones, but some governments actually prohibit the purchase of reinsurance. I'm not entirely sure why they would do that. But these are the sorts of things that we need to be able to challenge them on and to really question, okay, this rule is in place now. Perhaps it served its purpose. Is there another way in which we can start developing the market and help your domestic insurance sector to be able to improve the way in which it manages its risk, and ultimately help the private sector to help you as the government to manage your risk? And that's really the sort of where the discussion should be. Also a huge fan, it's a much softer engagement, but a huge fan of knowledge exchange and bringing in both government peers so they can have an exchange themselves. And so going through risk pools like CRIF, for example, are incredibly helpful with this, allowing governments to have that exchange themselves, combined with people from the private sector as well. I also feel that's very important that the private sector has a voice at these exchanges too. And I would leave it at that.
Thank you very much. And it's really having a nice flow of the discussion. And I think we come to an end. The time is running, but it might be combined with the last question from the audience, Nicola, and giving some thoughts on actions that can be taken. The question was that participants, and happy to see you brought the idea of service as a distinct element of infrastructure. To his mind or her mind, this is closely linked to the quality of human resources and how well they understand the risk resilience agenda and their role and responsibility to reduce risk. Any reflections from you on the cost of integrating risk in the entire enterprise of operating particular infrastructure? So, but I think that is a segue to kind of actions that can be taken. Over to you, Nicola.
Thank you, Astrid, and thank you to the member of the audience, that really tricky question to end on as well. Thank you, Astrid, for putting that one to me. Yeah, so we'll maybe just to step back a bit. I think the answer to the question is the need to integrate risk throughout an organization, be that government or be that an infrastructure investor or an infrastructure operator, is really critical. And obviously the first point of that is understanding that this is important, understanding what the risks actually are, so how to understand those risks. But one point that I would like to come back to, or maybe 2 points, is one particularly on the government side, but I think this also applies to private sector as well. The importance of encoding risk into that sort of fundamental fiscal planning within government. And that's such an important part of this. Even in the UK, and actually we don't have a great record on risk management right now, but even in the UK, in our fiscal risk reports, it's only in the last year that we've started to include climate change. And if you're not really including climate and disaster risk within that core functions of government, so in your fiscal risk reporting, in your budgeting, you're missing that out, and that you're missing out on both the potential to manage that risk better to government, but also to create the right incentives throughout society and the right risk signals. So if you're not doing that in government, that's a real problem. And I'd like to advocate as well for something that I know others have as well, which is a sort of chief risk officer in government and a national risk board in government. So there really needs to be a central place of understanding a risk and making sure that's encoded. And the private sector actually already has many systems in place like that. So in many ways, government can learn from what the private sector is doing, and particularly insurance sector as well. Coming on to the sort of next steps and wrap up then, I guess, so some concluding thoughts. I think so it's difficult to think about as steps. I think more than steps, to think about an ecosystem. We need an ecosystem to help advance this agenda, and part of that is and we've gone over a few of them. So I've sort of written down 4. So part of that ecosystem is we need some entities that can provide really long-term support to governments in this area, long-term technical assistance. And the long-term is really important there, because this does take several years. We've talked about the need to invest in data up front, the need to put in place an enabling regulatory environment for this. So you need actors in the system. And I know the World Bank is extremely good at this. There are other actors that are very good at this. CDRI is starting to do this. IGP is starting to do this, that can actually be there for years to stand with the government as it comes through this process. And that's really important, that role. So that's part 1. Part 2 is the public goods aspect to this. So we need to improve availability of data globally, and my entity focuses on this, and we're working very closely with CCRI and CDRI and the World Bank and others in this area as well. But we need to come together and really resolve this data problem, and this can be done. We just need to come together and do it, and make this data available to countries. So there's that part. And then the other part of the public goods is the training. And I think it was Samantha that made this point, the importance of knowledge sharing between governments. So having support for those types of long-term training programs and capacity building programs is really important as well. So that's part 2, the public goods. Part 3, I would say risk pools again. I know all of us have been evangelical about risk pools today, but risk pools play such an important role, not just on the actual providing of insurance, but everything around that. You know, they're great vehicles for supporting understanding of risk, capacity building. And actually, there's some really exciting stuff happening now on the investment side of risk pools, particularly in high income countries. Actually, how do you take the investment side of a risk pool and put that more into building resilient infrastructure? So I think risk pools can play a really important role. And then the final bit is the private sector. So the private sector is the engine of capital and expertise in managing risk and the financial instruments. And they're an incredibly important part of this system as well. So this ecosystem, and I'm sorry to anyone that I've missed in my ecosystem, but I think all 4 parts are really, really critical and has to come together and work together. And I think, the actors on this panel here are all really important parts of that and of taking this forward. But I think, working together to really advance this is the next step. Thanks.
Thank you, Nicola. That was the best final word. Cannot add more, but I think you put out an additional future agenda for work to drive that forward, to support the countries, especially the governments, but also to call on the international actors that are in this community to pull forces together and collaborate strongly for the sake of providing good solutions. I think that's fantastic what we've heard. There are more questions coming that came in. We hope we can, and you also can touch base with the organizers here in order to get more support, probably also guidance directly for the work you're doing here out in the countries. And hopefully we could stimulate a lot of ideas for you going ahead. With that, I would also like to bring your attention to the next event of this dialogue series that will take place on the 23rd of September. This is on the financial case of resilient infrastructure, integrating physical climate risk into business investment decisions. Further information, of course, will be shared upfront by CDRI via email. And before we come to the final poll with you, audience, I would like to give a very big thank you to my dear panelists, Nicola, Samantha, Isaac, and Rowan. This was a fantastic discussion and really inspiring. I roll up my sleeves. I think for the partnership, we have a lot of things to do. And thank you so much for being here and sharing your experiences and thoughts. Thank you all for being here. And before you leave, please look at the final poll. We do have some questions on how much valuable knowledge you gained here now, and how much you can use this information immediately on a long-term basis or not sure, or how much would you rate the overall experiences of this webinar. And with those questions, I'm leaving you, and I wish you a lovely morning, day, afternoon, evening, wherever you are, and stay safe. Thank you very much.
Thank you, Astrid.
Thanks, Astrid.
Thanks,
Take care.
everyone. Bye-bye.
Thank you. Bye to all.